Welcome to Trillions. I'm Joel Weber.
And I'm Eric Balchunas.
Eric, there's a country that is actually like big in ETFs, and we actually don't really talk about it enough, but you're heading to Asia on a trip, and then all of a sudden we started talking about Japan, and I was like, well, you know what? We should actually do a Japan episode. And to do that, we're going to have Jeremy Schwartz, who's the Global Chief Investment Officer at WisdomTree, joining us. What are we going to talk to him about, Eric?
Yeah, well, beyond those reasons, there's also a new prime minister there who, by all accounts, is very like Abe. And Abenomics was a whole thing from about 10 years ago where this guy just he did a lot of, currency manipulation in order to jack up exports. And that created what was called the fee wars for a couple of years there. And DXJ, which is the WisdomTree Japan Hedge ETF, was like a total rock star. In fact, remember the trivia episode we did? One of the trivia questions was, what was the last ETF that wasn't Vanguard or iShares to win the annual Flow Crown? And the answer is DXJ. In 2013, it took in $9 billion. But then it started to underperform the non-hedged. A lot of people left. It was like a rise and then a fall. Then it actually had a good run again, but people didn't really come back like they did. It was like it didn't get a second bite at the apple, which we've seen on occasion. But with this leader in here, maybe it will get a third bite at the apple. Maybe this time it will work. I can already see some of the assets growing in it, but it's still basically a shell of what it was 10 years ago. But the design of DXJ should be perfectly fit for this prime minister, if what I'm reading is true.
That prime minister is Sanae Takaichi, the first female prime minister in Japan's history. Her nickname is a throwback to Margaret Thatcher, the Iron Lady. And joining us is Jeremy Schwartz of WisdomTree. This time on Trillions, is Japan back? Jeremy, welcome back to Trillions.
Thanks so much for having me. One of my favorite topics to talk about with Eric, from first episode of ETF IQ to back. Japan might be coming back.
Oh, yeah.
So, Jeremy, we did a check. You were on in April of 2022. It's been a second, so excited to have you back. So let's hear you answer the question. Is Japan back? I'm going to guess you're going to say the affirmative.
Well, the thing is that Japan never left.
Okay.
I mean, the thing is, people might have traded it wrong, but if I look at the performance of DXJ compared to the S&P 500 since 2012, how many international funds can you say have beaten the S&P 500 since 2012? IFA, by the way, MSCI IFA, the broad international benchmark that everybody buys for international, has returned like 7% a year. The S&P's done 15% a year, okay? And so 7 versus 15 for 13 years, by the way, compounds to like 150% versus 500%. So this is how much international has beaten. What has beaten the S&P since that time? DXJ. So it's like, now there's a period where it wasn't, but as of today, that's, and we're recording early October, that is true. And so there's been, I think, this comes back to a fundamental problem through international. I mean, Eric, this is something I've talked about for a long time. This is somewhat a branding problem, but, it also just is a sequencing problem that people think hedging is this exotic thing when, like, betting on currencies is actually a much more interesting, more exotic thing. Like, why do you want to go long the yen? If you had to say default, should you be long the yen or should you just be neutral the yen? Most people would have been neutral, but they default to being long the yen all the time. It's kind of a crazy thing. But I'd say DXJ never left, but people left. And they made a mistake.
So what's interesting about that timeline that you lay out is just how much has actually changed in Japan. This huge monetary policy experiment. It was they had like negative interest rates forever. Year and change ago, they left that and like re-entered sort of the normalcy. Now there's inflation, and even Japanese are starting to have to invest differently because they can't just keep cash under the mattress anymore. So is DXJ's success, is it really like the international investment opportunity, or is there a domestic story there too?
Yeah, people do ask that question about if it's also one of the oldest populations, so a declining population. So like when we talk about it, is it really about the local Japan story or just their global, sort of footprint? I have said that it's not about just the local economy, that Japan is generally like a global growth play, that it sort of exports all around the world. They have some of the they're the infrastructure, some of their semiconductors can find their way. SoftBank is like an AI play. Tokyo Electron feeds into a lot of the other global AI stories. So they are components. They don't have like I'd say the Mag 7, like we have these tech leaders, but they have things that support a lot of that. I'd say the other person who's brought the most interest to Japan has been Buffett. So like you think about world's premier best value investors, 5 years ago, I was telling people, follow Buffett in Japan. I'd probably done 6 or 7 different pieces, follow Buffett into Japan. And in fact, I actually then created a fund to buy half the stocks, half of its weight basically is in the Buffett stocks. So OPBJ, Japan Opportunities. We took a smaller fund to do that. We had a small cap fund. That was the more local story. I just said, people don't care enough about the small caps. As much as I cared, people didn't care. But the Japan Opportunity story with Buffett tagging along actually is just as interesting today, actually.
When we look at the year-to-date returns, it's pretty close. So the non-hedged is up 18%, DXJ is up about the same, and the S&P is up 13%. Now, the dollar has been weakening, and usually if the dollar's weakening, it's not good for currency-hedged international ETFs. Right? You want the dollar strengthening and Japan's currency getting weaker. That's the perfect trade for DXJ. Is this prime minister going to do what Abe did and like really purposely make the currency worth less in order to jack up exports? And how much is left in that trade? Because when I just went back and looked at 5-year, DXJ is destroying the non-hedged. So I guess that would be my 2 questions as somebody thinking about going in now.
Yeah, it's a very tricky question. These currencies can be very unpredictable, which goes back to like, do you really want to bet on the yen going up? Which it's a high bar to say. Like, do I really want to bet on the yen? With DXJ, you're basically getting today. You're getting call it 3.5 to 4% on top of the local market. This is an important distinction because when you hedge, you get the interest rate differentials on top of the local market return. Like you hear about the yen carry trade, you hear about these carry trades. When you're hedging, you're paid the interest rate differentials between the local, between the U.S. and local market. So yes, the Fed's bringing rates down. Japan's been hiking a little bit. For a little while, we're getting 5 to 6% carry on top of the local market return, which again is how much the yen has to go up to break even with the hedge, right? So they're starting out 4% behind. The 8 ball is how much the unhedged has to go up. Now the dollar had been getting weak. A lot of people think the dollar had peaked out and things go. So it's not just in Japan's control. I mean, for sure, when Abe came in, you had 80 yen to the dollar. Today we're over 150 yen to the dollar. So it's definitely a very different starting point. It was a very overly strong yen when Abe came in. You wouldn't say it's an overly strong yen today. But it sort of comes back to the policies. Like if she's trying to get them to delay raising rates, if they do a lot more fiscal spending, they've got some of the highest debt to GDP. There's just the questions. It's like now she might be pro-growth and that might be good for the currency, but it's sort of it's unpredictable. So it's like, is that your thesis? The thesis is she's good for the equities. She might not be good for the currency. Or at least it adds extra noise and extra volatility when you could buy the stocks and get paid over 3% today to hedge it.
One thing you mentioned was the debt to GDP. As Joel knows, I've been deep in this Bitcoin book. And one of the things that you have to cover when you're covering this is deficit, debt, inflation. And I think the U.S. is like 130%. I have to double check that, but I believe Japan's double, 250%. They're basically like the highest in the world for a big country. That seems crazy to me, but as some people pointed out, that doesn't necessarily mean you're going to get a lot of inflation. And Japan is also, there's a famous like kind of meme on social media where somebody starts talking about U.S. stocks and somebody comes in, now do Japan. And it's usually looking at like the lost decade of Japan, like which was a couple decades ago, about how a stock market can just do nothing. So I guess with, I don't know, as an investor, and I'm thinking like, hey, this is a debt-ridden country. I don't hear a lot of things about Mag 7 type stocks there. What am I really buying here? Is it just the trade on monetary policy, and how much more monetary policy can be dovish or loose, given they're already at that debt to GDP level?
My friends at All Star Charts, JC Perez, Steve Straza, do these like 30-year breakout charts on Japan. Like, like it's been building this base for 30 years, and you just got like the Nikkei to break out at 48,000, and it's 1989 was the peak. It's just catching up to the 1989 peak, but it was like one of the greatest bubbles of all time. Like international stocks were like 60% Japan in 1989. It was one of the most expensive markets. You thought the tech bubble in 2000 was expensive. More of Japan was more expensive than tech bubble of 2000, right? That's how big it was. Now, it's the inverse today. If I look at that, I've got two different Japan funds, but let's just stay with DXJ, the flagship. 14.5 PE when the S&P is 23 PE. Okay, so S&P is selling at a 4 to 5% earnings yield. We've got a 2.5% equity premium, let's call it. Like we look at the earnings yield versus a tips yield. So, it'll take you over 40 years to double your money in bonds today in purchasing power terms, under 2% tips yield. Stocks might take you 14 to 15 years in the US at a 5% earnings yield. Japan at a 14 PE is like an 7 to 8% earnings yield. It's more like a 8 to 9 year doubling of your purchasing power. It's a much better value that is like I call it the inverse bubble. Like people just have lack of apathy. There's not any interest. International's been out of favor for this 15, 20 years. At the US Mag 7 have been in favor. And so nobody cares. And so the valuations support that. The Japan Opportunities Fund, which has all those Buffett stocks, is a 12.5 PE, 8% earnings yield, very high quality stocks, doing a ton of buybacks, growing the dividends. I mean, it's such a good value story in my opinion. And if you get any positive catalyst that these Takaichi trades, if she is, there's questions on how effective she's going to be. She's got to get her coalition together. But if she is productive in lowering taxes, if you talk about doing a 10% consumption, like bringing a flatter tax to 10% to try to re-stimulate demand, that could be a very, very big deal. And it's a cheap market. So, I obviously I like the market.
How big are these challenges that she faces, just to kind of lay out the landscape?
It's tough, man. I mean, it's a tough set of politics. She's got to figure out who's going to go with her, how she brings it. They do have these inflation problems, so people are somewhat, Eric, when you talk about the currency before versus Abe, the yen was way too strong before. Now people are worried that their yen aren't going as far and there's inflation, and so the weak yen makes it a hamstring. One of our former strategists said she needs to go for a strong yen policy. So there's questions, but that is one of the things she's got to confront. But she's definitely trying to bring a pro-growth mindset. The battle, like I call it, Eric, we launched an Asia Defense Fund, and Eric was giving me a hard time in the name of like, well, is there China in that Asia Defense Fund? And I said, well, no, this is with the battle for China. And
Joel, I told them they need to run with that and call it, I forget the name we came up with, Defending Ourselves from China, Asia Defense ETF, versus just like Asia Defense. I'm like, you should own the fact that it's a specific situation there.
I don't know if Jeremy wants to comment on that.
I mean, it is the battle with China fund in some ways. I mean, we called it Asia Defense. I thought it was implied that it was for the battle for China. But yes, I understand his point. Like, is it with China or for the battle? But that is very topical too. In Takaichi, one of the Takaichi trades, I wrote a piece, the Takaichi trades, and one of the trades is a defense positioning. Like, she is very strong against China, and she thinks if there were to be a conflict with Taiwan, she wants to defend Taiwan, and she wants to increase spending. And so she, now if you think back to the U.S. politics and geopolitics, there is, Trump is negotiating hard with China. Maybe by the time people hear this, they've negotiate some grand bargain, but it's hot. The China-U.S. has been one of the big hot topics this year. Abe was one of Trump's close allies, and then you had sort of a fledgling of prime ministers that weren't, doing as well with Trump. The idea was Takaichi might be a better negotiator with Trump on some of these issues, more friendly with Trump, because she is kind of viewed as this Abe 2.0 in some ways. But the defense story is one of the big stories. And so I think, the European defense was one of the hot ETFs this year. Like, we somehow in our European team launched a European defense fund like the week Zelensky was in the White House. And that fund just took off like you would expect. But we actually think this Asia defense today is the hotspot, actually, for where things could go over the next few years. And Takaichi is very supportive for Asian defense.
As long as we're talking about China and Trump and Japan sort of in the middle, but maybe leaning a little bit more towards Trump, I just want to go back to trade, which has obviously been the backdrop for so much of what we've been talking about all year. Japan, very much an export economy. I'm curious specifically about the automotive industry and sort of your exposure to it and how it's going to try and navigate what's to come and how that might impact your investments.
Yeah, that is why I've been highlighting this second fund I have, this Japan Opportunities Fund, because it's much more in the industrials, the 5 Buffett stocks than just betting on the car companies. Now, I'm not saying that DXJ is just the car companies, but in terms of the sectors, DXJ, 14.5 PE, it's going to have more exposure to like Toyota, which is its second largest holding, or Honda, which is in the top 10. So it's going to have 25%, maybe closer to 20% in consumer discretionaries. Industrial is still a big sector there, 25%. So it's more tied to that. The autos has been a sector, that China's rise has been competing with. Like my colleague Sam was just in Mexico, coming off of a Mexico trip.
BYD everywhere.
Everywhere. Like, everything is all China cars. And Elon had said, 9 of the 10 largest car companies are going to be Chinese, because of the competition. They are so strong. It's global competitive. I mean, that the car industry has been under pressure everywhere. And so that is China, a big China competitive dynamic.
I got an ETF nerd question for you here a little bit. DXJ, again, when I wrote my first book, The ETF Toolbox, it was like DXJ had taken over the industry. So I have a whole chapter called Currency Hedging, which isn't that big of a deal anymore. But at the time, that's how big it was. I made a whole chapter for it. And I just thought you guys really set the bar for how to market an ETF. I call it speedboat marketing. Instead of acting like an aircraft carrier, if you have one of these ETFs that gets hot, you drop everything and you rally around this one product. They had ads, Joel, on Bloomberg TV and elsewhere, take the yen out of Japan. I mean, that is good, right? Jeremy was everywhere. And Deutsche Bank had a competing product that had actually launched earlier, but DXJ got all the money. Now, DXJ then saw some outflows since, and it's had great performance, but it hasn't able to kind of get back to that peak. What do you make of that? We on a team have this phrase called it's hard to get a second bite at the apple. If you look at high flyers in history past, especially active managers, these shooting star types like the Janus 20, it's just hard to come back. Even if you come back performance-wise, it's hard to come back in a sort of zeitgeist way. How do you get DXJ back on people's radars, given that they might have been like, well, I did that ride already, and it was a little dizzying, and I'm not doing that again?
Yeah, it's very interesting. I'll say I probably talked more currency hedging than anybody in the industry for the last 15 years. I did my first one in 2009. I think I was the first ETF, actually. And the first one was broad EFA. And now, interestingly, in the history folklore, HEDJ, which became Europe, was the first one. We converted. It's fascinating. I remember talking with a market maker. We had a client who wanted to buy it, and the market maker didn't want to make, we're talking 2009, 2010. And they didn't want to quote all the spreads because you had to put on these hedges, and it was too wide of a thing. And the broad EFA just didn't take off. And then it was April of 2010. We had DXJ unhedged from 2006. April 2010, I added the hedge. We added the hedge to the yen. And then it took off during the earthquake in 2011. So the yen really went up, and people were starting to say, oh, it may be going up too much. And so it started to work for the yen. So it probably took about 500 million in 2011 timeframe after the earthquake. And we saw that it was working for a single currency with Japan. And then we made Hedge the European one, which we should have just launched a broad EFA one versus converting. But, who knows, going back in time. But then both of those took off. As you said, Eric, like the single currencies did take off. The broad EFAs took off. We've started doing a little bit below the radar now, some more active hedging. Like we have a multi-factor family that's actively hedging. We have a dynamic family. Probably our fund that's raising the most in the international markets this year has been a dynamic fund that does it just as part of the factors. So it does seem scary. Again, it comes back to branding. Like people think dynamic currency hedge, oh, it's some scary thing. But dynamic international, the branding I think is a bit better. In multi-factor, it's just one of the factors. And so we're trying to win the longer game, but for sure it reduces volatility, taking out this noisy thing. Currency moves 7-8% a year. Do you really want that volatility? I think most people wouldn't accept that volatility. It comes back to benchmarking questions that, all right, ACWI or EFA have the currency, so they feel like they're going to make an active call to hedge, but really the active call is to bet on the currency. It's like, really? You want to bet on the euro? Really? You have a long-term strong view on the euro?
This is the challenge with currency hedging. You have to actually change the way your mind works. You have to see, almost the way I would describe it, Jeremy, I would say, this lets you invest as if you're a person in Japan investing in the stock market.
Exactly.
It takes out this other element. So when you buy EWJ, you're actually buying two things. And I hear you, because I remember I used to say, this was an A minus B ETF, and you're like, no, it's just A. The other one, exactly. A plus B. Yeah, and you got me. It took a while. Some of this stuff takes a couple of years, but I also think you guys did a great job of diversifying away. You had like this huge hit song, but instead of just like relying on this one, like your next couple products over the next decade, you've got some huge hits that really diversified the product line. DXJ is still up there for you, but like you've got USFR and DGRW, both 17, 16 billion. We've written about that a couple times, but anyway, it's just interesting. WisdomTree has always been like an interesting case study, pure ETF company, publicly traded ETF company, and how to like survive after your big hit and not make sure you're not just living off of that, which I think is a good lesson for all the issuers out there.
Well, just as we come to the end here, Jeremy, like what's next?
Well, in some ways, it's interesting, Eric. You talked about the A plus B ETFs and A minus B ETFs. The one that's gaining a lot of traction now that should be so much bigger, if you said go back to the TV days, what we have on TV right now is our gold stack, our sort of capital efficient gold funds where you put gold on top of things. As gold up 50% year to date, we have basically U.S. equities plus gold futures on top of it, GDE, and then we have GDMN, which is miners plus gold that competes with that. Those are now, the miners have taken about 150 million this year. The gold overlay to the S&P kind of stocks, our own basket of 500 stocks, but GDE is
oh my
now
God, wow.
500.
GDMN is up 180%.
Top performing compared to your standard miners.
That's efficient gold plus miners. So that's gold miners. Is that like leveraged at 150 or something?
Well, it's 90-90. So 90% the stocks, 90% the futures. So it's it's adding the gold futures on top. And we do the same thing with core stocks. So if you go back to your deficit problems, the debt and deficits, people are worried about the dollar. You don't have to go to international to do that. Just add gold on top of your U.S. large stacks with GDE. So that is really A plus B. This is a good family.
By the way, Joel, they got a China X state-owned enterprises, and so that I told them that should be take the communism out of China, but they didn't run with that. I said that's on the house. It's pretty good, isn't it?
I'll bring it back up.
Then they have one for EM that's ex-state-owned EM companies, and I said probably can't. I'd say take the socialism out of the emerging markets.
I'm going to go back with that. I'm going to bring that back to the marketing team after we get off this call here.
All right. Well, you clearly have a way of surfing some interesting situations. So, Jeremy, thanks for coming back on Trillions, and looking forward to having you back again soon.
Always so much fun with you guys.
Thanks for listening to Trillions. Until next time, you can find us on the Bloomberg Terminal, Bloomberg.com, Apple Podcasts, Spotify, or wherever else you like to listen. We'd love to hear from you. Hit us up on social. I'm at Joel Weber Show. He's at Eric Balchunas. Trillions is produced by Magnus Henriksen. Sage Bauman is the head of Bloomberg Podcasts.